At my worst in January, I was down 4% on my overall account. It's not good. Clearly, it's not good. Don't get me wrong. But it's not as bad as, for example, the S&P 500. I talked about it in my previous video. But when I have losses, what do I have to do? You know it. I've been talking about it a lot on this channel. It's rolling losses until the next month, until the next expiration. And that's basically what we're going to do. I'm going to give you an overall update of my portfolio. I'm going to tell you like where I'm in the loss, where I'm in the gain. And I'm also going to roll some trades live so you can see how I do it, and hopefully it's useful for you if you want to do the same. So we are in my portfolio right now. As you can see, I have a couple of trades on. I have 3, 6, 9 trades on. You can see that my PNL year to date right there, I'm at minus $600. I lost $600. However, I made just today $700. So you can see that basically at the beginning of the day I was at minus 1500 or something. I'm at minus 600 because I made $700 in a day because the markets are just coming back in my favor, which is good, you know, but I just didn't expect to make that much money in a day, but you know, good for me. And at my worst, I think in January when the market like went down, I think like to the 4,200, like the S&P went to 4,200, I think I was down like 1,800, almost 2,000, and now I'm back at $591. So you see that it's not, honestly, it's not bad. But this down move also shows that, you know, the markets are not only going up. Like when it goes, it can go down a lot quicker than when it goes up. And that's honestly a good lesson, a good reminder. If anyone was feeling complacent, well, at least now you know that it can go down super quickly. Basically, you can see that you have this column which is called DTE. So it's days to expiration. So how am I going to choose the trades that I'm going to roll until the next expiration? Well, first of all, I'm going to look at all the trades that are in the loss. So as you can see, there are actually quite a couple of trades that are in the loss. Then on the ones that are quite close to expiration, that are usually around 20 days to expiration, 19 days, you can see right now it's 18. Well, I'm going to roll those ones to the next expiration, meaning that I had sold some options for the February expiration. Well, I'm going to close my trade in the February expiration. I'm going to buy back the option that I had sold, and I'm going to sell new ones in the March expiration. So if you don't know why I do this, well, the reason I'm doing it is that by doing this operation where you close your trade, you buy back the option, and you sell another one in a later expiration, you're going to do this overall transaction for what we call a credit. The reason why we're doing this for a credit is that the option that you sell in March is more expensive than the option that you buy back in February. And that has the benefit of improving your break-even zone, meaning that the bigger the credit, the easier it will be for you to make your money back once the stock comes back in your favor. I'll link some videos in the description of this video if you want to know more about rolling. I won't go into too much details here. I just want to show you like how do I roll like practically. So let's get into it. So the first trade that I'm going to take care of is a trade on American Airlines. So as you can see, I have a trade on American Airlines. I sold 2 puts on American Airlines. I'm in a loss of $212, which is a loss of 123%. But I made back $120 today. I had sold my puts at the 18 strike. So that basically means at that level. So if the stock was staying above $18 per share at expiration, then my puts would expire worthless. But as you can see, it went below that level. So what do I do now? Well, I'm going to do exactly what I said before. I'm going to roll my trade to the March expiration, to the next cycle expiration. So what do I do is that you can click on Tastyworks, and that's pretty cool because it's really made for options. You click on the trade that you have, then you click right, and you see that roll expiration, and then you have plenty of expirations that come up. You see that you have the 25th of February, 4th of March, 11th of March, 18th of March. Usually I will never roll my trades in weekly expiration. I will always take the next monthly expiration. And the reason I do this is that in weekly expiration, it's not sure that there is good liquidity. There's usually a lot more liquidity in the monthly expiration, so I'm usually going to go for the monthly expiration. So in our case, the monthly expiration would be the 18th of March. And you can see that you have this 33 cents of credit, 23 cents, 16 cents, 7 cents. That represents how much credit you'll be able to roll your trade for if you decide to roll it, for example, for the chosen expiration. So if I decide to roll it for the 18th of March expiration, I would collect a credit of 33 cents. Then it's going to directly load the trade. And as you can see, like it says that I'm going to roll the trade for 34 cents of credit. I'm going to buy back my options at $1.91 per option, and I'm going to sell the new ones in the March expiration at $2.21 for the same strike. So you can see that the option in the later expirations are worth more than the ones in the previous expiration. And the reason is very simple. There is value in time. The further away an option is in time, like the expiration, the more value there is in the expiration. So it makes sense that if you always roll your expiration forward, if you trade naked options, you'll always be able to roll for a credit, because by definition, there is more value the further away the option is. So I'm going to place the trade. I'm going to decrease my limit price so it's filled directly, and then I'm going to click on review and send order. You heard the noise. That means that my trade got filled. And now if we go back in my positions tab, we can see that now for my trade on American Airlines, now you see that the DT is 46 days, because now it's in the March expiration compared to before where it was the February expiration. There was only 18 days to expiration. Make sense? All right, let's go to the next one now. So which one should I do? So first of all, I'm going to look at the ones where, for example, I have 18 days. So let's say I roll now this one on Under Armour. It's basically the same problem. I have a $218 loss. I think I had sold 2 contracts. I'm going to do the same roll expiration until the March expiration. I'm going to decrease a bit my mid price to make sure I'm getting filled directly. Review and send. And you see that now you didn't hear the noise, and the reason why is that my trade didn't get filled yet. So you can wait. You can absolutely wait and see if your trade gets filled at some point. Personally, I like to see my trade being filled directly. So what I do is that I'm going to modify my trade so as to make sure that it gets filled directly by decreasing the credit that I'm going to receive. By doing this, I'm going to find more liquidity. I'm still not getting filled, so you can see that it's actually kind of hard to get filled on this trade. Maybe there is a bit of a lack of liquidity. Now you heard the noise, it means that I got filled on Under Armour. So if you wonder like, okay, but do you do this every time like you get around 19 days to expiration and you are in the loss? Yes, that's what I do every month. If I see that I have trades in the loss, I'm just going to roll them to the next expiration. You must have heard this way of managing trades by Tasty Trade. That's something that I learned from them at first, and then I tend to wait a bit more than them. Like I think they usually roll their trades around like 22-23 days to expiration. Usually I like to wait maybe 5 days more just to make sure that all right, that trade is in the loss, now I can roll it. But that's just my personal preference. So now I'd like to focus on a trade that is on EWZ. So on EWZ is the ETF for the Brazil economy, if I'm not mistaken, and you can see that I'm in a gain of $348. Am I going to roll that trade also? Because you can see it's at 18 days to expiration. Well, for that trade, it's a bit particular because I had basically sold an option back in August. So I had sold basically the 36 strike put option when we were in August. The stock was around $37 per share at the time where I sold the put option. So you can see that I got wrong, but like I got proper wrong on that trade. The thing went like 20% against me probably, and now I'm almost back at break even. And something that is really interesting to note, at my worst I had a loss of around like $700 just on that trade. Now I'm almost back to break even, meaning that I had managed to reduce my loss at $400, and now I'm at a gain of $348, meaning that in $60 gain, I'll be at complete break even, as if I had made no money, but I have also lost no money. But the thing that you need to also look at is that I didn't need the stock to come back as much as it was before in August at $37 per share to come back at break even. And that's the amazing thing with options, that when you keep rolling your trade, when you keep rolling your options, you're going to collect that credit, and in the end you won't need the stock to come back as much as what you needed to if you had, for example, bought the stock. Because let's say that you buy the stock, let's say that you buy, for example, 100 shares of EWZ at $37 per share. Well, if the stock, let's say, falls to 20, well, you need the stock to come back at 37 so as to come back at break even, because above that point, you're going to make money. Below that point, you're going to lose money. Well, with options, the bigger the credit you will receive, the less you will need the stock to come back in your favor so as to come back to break even, because your break even is going to go lower and lower over time as you roll more and more for credit. So that's really the amazing thing. And as long as you keep trading, quality stocks, like not insane stocks, and you keep rolling for credit, well, you're going to to be fine. It's probably going to come back in your favor at some point, and you'll probably be able to go out of the trade at least, you know, at break even. Like, you won't have made money, but you won't have lost money. And to be honest, because I had this trade since August and it went like $700 against me, and now it's only like a minus $60 loss overall, I'm really tempted to just close my trade and not roll it to the next expiration, because honestly, it's been a pain. And you know, something that you also need to consider is that, is the money that you're tying up to that trade really worth it? Like, should you roll your trade all the time? Maybe there are better opportunities, and that's something that some of you have mentioned in the comment section, like on my previous video, and it's called the opportunity cost. And honestly, there's plenty of fair points when it comes to just closing your trades, taking your loss, and just moving on and putting your money where it, you know, there is more opportunity. It's absolutely fair, because you see that it's still taking $1,110 of buying power. And that money, maybe I could put it for a better trade. So I think that I'm just going to close that trade and call it a day, because I've been having it since August, and you cannot imagine for how long I've been wanting to do this, like literally 7 months. So I'm going to click right, close position. You see that I would basically make a profit of around $340, but if you click on it, it's going to include your previous loss that you had on that trade. So if I click on max profit, you see that overall, I'm going to make a loss of $69. But when you put it in perspective of everything, a $69 loss is not that much. So I think I'm just going to take my loss and call it a day. And to be honest, I'm very happy that I don't have to take care of that trade again. It's done. Nice. So now, which one should I do? I have a trade also on apps, so you can see that I have sold the 50 put, and if we look on the chart, that's basically where I sold my put at, and you can see that the stock went against me. I'm going to do the exact same thing that I've done for the others, so I'm going to select my put, roll expiration, and you can see that if I roll it to the March expiration, I can collect a credit of $1.25, which is pretty good, you know. So I'm going to do this. Now it's filled also. And last but not least, one of the worst trades that I've had in 2021, I think like the worst by far, it's a trade on Bank of America. If you've been watching my videos, you must probably remember this trade that I had, like I had made a video about it where I had lost 700%. I mean, honestly, chaos, that trade. If we look at the chart, I had sold the 41 strike. So I think the stock was around like $40 at the time. It went to almost like $50. I think it went to $50 actually. And then now it's actually at $46. So you see that it's better than $50, but I'm not out of troubles yet. So I'm just going to continue rolling that trade. So I'm going to select the call that I had sold, and then I'm going to roll it to the March expiration. And once again, I'm going to decrease a bit my mid price just to make sure that I get filled. Send order. And then boom, it's filled. Actually, I forgot that I had one last trade on LVS that I didn't roll yet. You see that I had basically sold a strangle. So if you don't know what a strangle is when you sell a put and a call at the same time. So you're essentially betting that the stock is going to stay within a range. So here I had sold a 40 put and 42 call, but as you can see, the stock is around 43.69, so it's almost breaching actually my call side. And you will see that very often it's actually the call side that is causing troubles. And honestly, more and more I start wondering, why do I bother selling calls? And I know it's important to also, you know, be short the market so you don't put all your eggs in the same basket, so you're not only long, but honestly it's just a pain. Like if you've been selling calls, you know the struggle, like, you know, it's always a pain. And the way I'm going to roll strangles, I'm just going to do the exact same thing. No, I'm not going to change the strikes. I'm just selecting the two legs, roll expiration, and then I roll until the next one. You see that overall, I'm going to buy back my put and my call in the February expiration. I'm going to sell another put and another call at the same strike, but in the March expiration like I did before. So I'm going to just decrease the price just to make sure I get filled. And once again, it's filled. I hope that was insightful to see how I trade, what are the things that I consider, how do I do it, do I keep the same strikes? I know that those are usually questions that people ask, so, you know, hopefully that was useful for you. Please make good and informed decisions. I'll see you in the next video, and in the meantime, I wish you all the best.